Something just happened that has only occurred 4 times in the last century, and every single time it did, the investors who understood what it meant walked away wealthy. The ones who didn't lost years of gains in months. I'm going to show you exactly what it is, why it's happening right now, and specifically where the smart money is moving before the rest of the world figures it out. Stay with me, because the second point in this video is the one that could change your entire financial position this year. The World Uncertainty Index just hit its highest level in over 30 years, not close to the highest, higher than COVID, higher than the 2008 collapse, higher than the days after September 11th. And this is not someone's opinion. This is a cold mathematical measure, tracking how often the word uncertainty appears across central bank statements, corporate earnings calls, economic policy documents, and institutional forecasts worldwide. When that number reaches levels that dwarf every modern crisis, it is delivering one message with absolute clarity. The range of outcomes for the global economy has widened beyond what any professional model can confidently predict. Now here's what that actually means for your money. And I promise you, it is not what most people are saying. If this kind of daily analysis is what you've been missing, hit subscribe right now. We track this every single day, so you don't have to. But before I show you where the money is rotating, I need to explain why this crisis is fundamentally different from every downturn you've been taught to expect. Because if you misidentify what kind of crisis this is, every decision you make from here will be wrong. Most investors, including most professionals, are treating this like a standard market correction. A valuation reset. Earnings come down, confidence dips, the market falls 15 or 20%, and then it recovers. That is the pattern of the post-1971 era. That is the mental model almost everyone is using. And in this environment, that mental model is a trap. What is happening right now is not a valuation correction. It is a structural repricing of the entire operating environment for capital. You have an active military conflict disrupting the world's most critical oil corridor. You have tariff-driven trade fragmentation breaking apart supply chains that took 30 years to build. You have a weakening dollar eroding the purchasing power of dollar-denominated reserves globally. You have inflation proving more persistent than any official forecast predicted. And you have a Federal Reserve that is caught between two policy constraints it physically cannot satisfy at the same time: raise rates and crush growth, cut rates and reignite inflation. This is not a temporary shock that reverses when sentiment improves. These are structural changes to the world. And structural changes produce structural winners and structural losers in the stock market. Not for weeks, for years. Drop a comment right now. Tell me which sector you think benefits most. I'll reply to every answer in the first hour. Now I'm going to walk you through the exact framework that institutional investors use to navigate this, a framework that has worked across every major crisis of the past 50 years. But I want you to pay close attention to Phase 2, because that is exactly where we are right now, and most people are about to make a catastrophic mistake. Every major crisis moves through 3 predictable phases. The phase you are in when you act determines everything. Phase 1 is the shock, the initial days to weeks. Fear dominates. Algorithms amplify volatility. The VIX is the only signal the market is reading. In this phase, the S&P typically drops 5 to 10% in the first 2 weeks. Gold and oil spike on fear. Defense stocks jump on the obvious thesis. And retail investors make one of 3 mistakes. They sell everything and move to cash, locking in losses while guaranteeing they miss the recovery. They freeze, doing nothing, while a portfolio built for a different world quietly erodes. Or they chase the spikes, buying gold after it's already moved, piling into energy after it's up 40%. Institutions do none of that. In the shock phase, institutions are not reacting to price. They are building their watch lists for what comes next. Phase 2 is repricing. This typically begins 3 to 6 weeks after the initial shock. The market starts asking more sophisticated questions. Not "is this bad," but "how long does this last? What are the second-order effects which companies can pass through higher costs and which cannot?" Markets often partially recover at the index level during repricing. But underneath that surface recovery, enormous capital flows are moving between sectors at a pace that is completely invisible in the headline numbers. This is the phase we are in right now, and phase 3, rotation, is where the real money is made or permanently missed. Capital follows earnings, always, eventually. The sectors genuinely positioned for the new structural environment see sustained inflows that can last quarters or years. The investors who understood the rotation early capture the extraordinary returns. The investors still sitting in cash, still frozen, still holding the sectors built for the old world, watch it happen without understanding why. So let me now tell you the 4 specific sectors that institutional research is identifying as structural winners. And I want you to pay especially close attention to the third one, because it contains a mathematical mechanism that almost nobody outside of professional fund management actually understands. Energy infrastructure is the first, and I want to be precise here. This is not the obvious trade. Buying oil producers when a critical shipping corridor is disrupted was correct for phase 1. That trade is now a second-order bet on geopolitical outcomes nobody can predict. The real trade is the physical infrastructure layer: pipelines, storage terminals, LNG processing facilities, and export terminals. These assets benefit 2 ways simultaneously: directly from higher energy prices improving their cash flows, and strategically from the global imperative every major economy now has to reduce energy dependency and build domestic supply resilience. That investment will flow through the balance sheets of the companies that build and operate the physical infrastructure of the energy system. The investment horizon for this thesis is years, not weeks. Defense and aerospace is the second structural winner. But again, the distinction between the obvious trade and the real trade matters. The headline defense names spiked 40% or more in phase 1. That was algorithmic fear buying, not fundamental re-rating. The real opportunity is in the specialized suppliers of AI-driven defense systems, drone technology, cybersecurity infrastructure, and next-generation communications architecture. U.S. defense spending is heading toward an increase that could approach 50% over the next several years. That money flows disproportionately to the companies building autonomous systems, directed energy, cyber defense, and space-based intelligence, most of which are not yet household names and whose valuations have not yet caught up to their earnings trajectory. Gold miners are the third winner, and this is the one I want you to understand mechanically because it is the most powerful and the most misunderstood. A gold miner's revenue moves directly with the gold price. Its costs, labor, energy, equipment, are largely fixed in the near term. When gold moves from where it is now toward the $6,000 target range that multiple major institutional research notes have published, the miner's revenue increases proportionally. Its costs do not. A 25% move in gold can produce a 30 to 40% expansion in operating profit, depending on the miner's specific cost structure. This operating leverage is why miners historically outperform bullion during sustained gold bull markets. And the structural tailwinds for gold right now, dollar weakness, Fed accommodation risk, accelerating central bank accumulation, active de-dollarization, are as powerful as any point in the last several decades. Consumer staples are the fourth winner, and they are the most overlooked because they are the least exciting. Companies selling food, beverages, household products, and personal care items, the things people buy regardless of their confidence in the economy, have 2 characteristics that are specifically valuable in this environment. First, pricing power. When input costs rise from inflation, they pass those costs through to consumers because their products are non-discretionary. Second, earnings stability. Their revenues don't collapse proportionally with GDP in a stagflationary environment. Consumer staples are one of the only equity categories capable of delivering positive real returns when the macro regime shifts to stagflation, which is exactly what the OECD and multiple institutional forecasters are now describing as the most probable near-term outcome. If you want this sector breakdown updated daily with specific data signals, subscribe now. This is exactly the kind of analysis we publish every single day. Now here's the part of this video that I need you to hear very carefully, because the biggest danger in this market is not the crash everyone is talking about. It is something far quieter, far slower, and far more damaging to your long-term wealth, and most investors will never see it coming. The sectors structurally challenged in this environment deserve equal attention. Consumer discretionary, companies selling what people want but don't need, faces genuine fundamental deterioration. High oil prices, inflation eroding purchasing power, elevated mortgage rates, depressed consumer confidence. Discretionary revenues fall while costs rise simultaneously. This is not a sentiment issue. It is an earnings issue. And earnings issues produce sustained underperformance. Airlines are perhaps the most directly exposed. Jet fuel is a dominant operating cost. When oil is elevated, particularly for smaller carriers with limited hedging capability, the cost structure becomes brutal, and the revenue side is simultaneously under pressure from reduced business travel and consumer caution. Higher costs, lower revenue. That is the definition of margin compression. Growth technology faces a structural arithmetic problem. When real yields are elevated, the present value of future cash flows falls by mathematical necessity. The companies whose multiples were calibrated to near zero interest rates face a genuine headwind as long as rates remain elevated. A credible Fed easing path changes this, but that path requires oil to moderate enough for inflation expectations to fall. It does not exist in the scenario where the conflict re-escalates and oil returns to $125 or $150. Now let's talk about the dollar, because this is the variable most underappreciated in retail analysis and most central to institutional positioning. The dollar index has weakened materially from its recent highs. Its share of global reserves has declined from 71% in 2001 to under 58% today. The Wall Street Journal, not an alarmist publication, has described this erosion as a real structural shift. When the dollar weakens, gold rises in dollar terms. Oil rises in dollar terms. The foreign earnings of U.S. multinationals translate into more dollars. And emerging market economies with dollar-denominated debt see their fiscal burden ease in local currency terms, improving their growth outlook. A weakening dollar is capital flowing out of purely dollar-denominated assets, out of cash, out of U.S. treasuries, and into hard assets, international equities, and inflation-sensitive positions that maintain purchasing power as the dollar's real value erodes. If your portfolio is 100% U.S. stocks, U.S. cash, and U.S. bonds, a sustained dollar weakening is working against you in real terms, even if your nominal returns look stable. And now, the scenario that nobody in financial media is willing to say out loud, the one that is more dangerous than any crash, the one that could quietly destroy a decade of your savings without your portfolio ever going to zero. Here is what the institutions managing the largest pools of capital are doing right now. They are not betting on a single scenario. They are constructing portfolios with explicit positioning for multiple outcomes, with each position sized to reflect their probability assessment of each scenario. They are not asking, will the market go up or down? That question changes its answer every single week based on the latest headline, the latest central bank statement, the latest geopolitical development. The question they are asking is, where is the money flowing and why? Money flows follow earnings expectations. Earnings expectations follow structural conditions: oil prices, inflation, Fed policy, dollar direction, and the specific impact of each on each sector's revenue and cost structure. And those structural conditions are changing right now, in real time, every single day. The unthinkable outcome, the one that nobody in financial media is saying clearly enough, is not a crash. A crash is thinkable. Everyone has been discussing it for months. The unthinkable outcome is a sustained multi-year period in which the headline stock index grinds sideways or modestly upward, while beneath that surface, the sectors positioned for the new structural environment deliver exceptional returns, and the sectors built for the old environment deliver sustained losses. That is the stagflationary equity scenario. It is the scenario where sitting in an index fund and waiting for the recovery gives you nominal gains and real losses, while the investors who understood the rotation early captured extraordinary returns in the specific sectors the new environment is rewarding. The patterns are not new. The money flows are not random. The framework exists, it is systematic, and it has worked across every major crisis of the modern era. The question is not whether the rotation is coming. The question is whether you understand it before it is complete, or whether you read about it afterward, wondering where the opportunity went. We publish this analysis every single day. New data, new signals, new sector updates. If you are serious about being on the right side of what is coming, subscribe right now and turn on notifications so you never miss a daily update. And drop your biggest question in the comments below. The most important question gets answered in tomorrow's video.